Hello, and welcome to the special presentation for Friday, January 5th, 2018. My name is Glenn Tompkins. I'm a Senior Product Support Representative and Instructor here at VectorVest, and it's my pleasure to give your presentation this evening. This is the first presentation for the year of 2018, and this week's strategy is entitled, "And the Winners Are." We issued a portfolio challenge at the end of October of 2017, and it ran until December 31st of 2017. And the winners are going to be presented today, and we're going to take a look at the losers as well. So, without further ado, let's get right into the software. And we're going to go straight to the contest winners and losers and the results. We'll go up to the tab at the top that says Views, and we're going to go out to the previous Friday's views by clicking in the calendar box. Go out to the 29th. That was just a couple of days before the finish of the competition. We'll click on OK. And if we scroll down, we're going to get to a link that we presented for you to get to the results. Our all VectorVest portfolio competition, which began on October 30th, and you can click on this link to follow the results. So I'm going to click there. We had competition for Team Jockey Club. These are the people who had the Derby. And Team Midnight Cowboy. These are the people who did not have the Derby. And the idea was we were going to set up portfolios that could be automated, that we could take a look at and hopefully glean some good information on how to effectively use the VectorVest software along with the automation to make money. So Team Jockey Club is where we're going to start off with today. We'll click on Team Jockey Club. And the top three winners were contestants 194, 231, and 249. And what I'd like to do is go through these and take a look at what they did so that we can get some good information on how to set up a good quality portfolio that could be fully automated in the VectorVest software. Contestant number 194 within Team Jockey Club came out at 30.89% for that 2-month time period. Notice that the ending date was December 29th. It was supposed to be the 31st, but the 31st was on a Sunday. So the last actual trading day of the portfolio competition was the 29th. 30.89%. That's not bad for 2 months worth of time. Number 231 finished at 27.37%, and 249 finished at 23.59%. No matter where you finished in here, I would like to congratulate everyone who took the opportunity to participate, because these results by far are excellent results for a 2-month time period using the power of the VectorVest software. Let's dig a little deeper into 194. I'll click on the little blue mark here, which was the trading system. This contestant used the primary wave. In the primary wave, though, their fill mode was the Derby. If I click here, they were using the Derby to find their stocks. Find stocks from the top-ranked Derby searches based upon market timing, purchase window, and fill from Derby settings with the Genius. They were sorting their results by ROI, or return on investment. The stocks that did the best within the Derby using the analysis mode of today's Derby. They were very strong in looking at what was going on today in the Derby, tracking the price from the market open, looking at prices of stocks that were greater than $2 and average volume greater than 500,000 shares. So lower dollar stocks greater than $2, not penny stocks, but really high volume, which showed a lot of liquidity. The number of stocks that needed to be found were greater than 10, so that all of the stocks would have been 10 stock portfolios. The percentage of winners. So they were looking from today's Derby, from the price of the market open, but looking in the portfolios that had at least 7 out of the 10 stocks making money. Again, this is helping to ensure that this portfolio was doing well before it chose its stocks. Delta's positive. They wanted the deltas, the 5, the 10, the 15, the 20, and 30 minute to all be positive, sorting by ROI. That was their searches criteria. They wanted to maintain 5 positions, automatically replace closed positions. So if a position got stopped out by loss, which was the 25% gain or 5% loss, they would automatically replace stocks. When entering this situation, don't close any open position. This was allowing the portfolio to be hedged between long positions and short positions all at the same time. Don't replace any stock I currently own. Now, if you close out of a position, it could buy back into that position in the same day. This setting here could help you to bring up a lot of stocks that could trade a lot often and bring up a lot of commission fees. Don't buy stock if it violates the stock criteria. They did use the stocks per industry, no more than 3 per industry or sector. This was helping them to maintain a nicely diversified portfolio. Now, let's go over to the downside. When the rules were down for the primary wave down, they were selling short, also filling from the Derby. Now, they were looking at still today's Derby, from the market open, prices greater than $2, average volume greater than 500,000 shares. Again, making sure to include a lot of liquidity. Still looking for portfolios with at least 10 stocks. Average winners in this one was looking at least 60%. So 6 out of the 10 stocks had to be making money in that portfolio looking at today's Derby. This one used a stop of a profit locker, 40% target, 8% stop. This means that the stock, if it went up to 40%, it would stand a chance on getting closed. I'll talk about that in a second, a little bit more. But the most amount of money they were losing in any given position was 8%. As the stock's price got closer to the 40% target, this stop got a little smaller, thus locking in the profits as the stock's price decided to go back down. Now, profit locker target 40%. Once it hits that 40% target, it automatically activates a 1% trailing stop. This allows those winners to run a little bit more and only looking for a drawdown or a pullback of a 1% trail after it hit the profit locker target. All right, so this still allowed stocks to go and run and not giving up more than 8%. Now, the profit locker is a little different from the percentage gain loss because with this stop, I'm either getting out at a 25% gain or a 5% loss. How many times have you seen a stock go up 20, 23% and then pull back down? When do you get out? When it gets to be a 5% loss. The profit locker gives you the opportunity to get closer to your target and lock in profits as this number gets smaller as you get closer to the target. I actually prefer the profit locker over the percent gain loss as we've started to introduce this more and more into the software. But either way, they worked out well, giving you a 30% gain. In this portfolio, don't repurchase the same stock for 1 day after sale. Now, on the short side, they were saying if you got out of the stock, it would wait at least 1 day to buy it back. Whereas on the long side, don't repurchase any stock I currently own, means I could get out of the stock today and get back into the stock today, and again, increasing your commissions. And that was the setup for that portfolio. Let me close that out. Let's go back. The equity curve. This is what the equity curve looked like for the 2-month time period. Nice looking equity curve, definitely moving from the bottom left to the top right. As you can see, the portfolio is currently in cash right now, but this was your leader going up over 30% in that 2-month time frame. And look at that equity curve. That is a beautiful equity curve. Let's go look at the next one, number 231. What were they using? They were using the DTI Combo 1. Now, as a Derby user, you have something called the DTI or the Derby timing indicator. And you use this indicator based on a scale between 0 and 2. This indicator is a very fast indicator and uses different values on the Derby timing indicator. Once it hits a certain level at a certain point in time throughout the day, it will trigger. Normally, when it gets to above 1.20 at 10 o'clock, for the rest of the day, this signal is in play. But on a day that the market is really rocking and rolling in both directions, this could actually turn short for the day and trigger you to be in short positions. So it's a very fast timing indicator that's only used if you have the Derby. In this one, we were filling from the Derby, looking at stocks sorted by return on investment. Analysis mode, again, was using today's Derby. Entry price to market open. Price all and volume all was looking for all stocks that were greater than $1 and average volume greater than at least 100,000 shares, making sure that each portfolio had at least 10 stocks. Now the percentage winners here was greater than 60%, saying that in that 10 stock portfolio, 6 out of the 10 stocks were making money, sorting these stocks by return on investment. This also used a profit locker of a 25% target and a 7% stop. I like the stops that I see on both of these top two, giving you an opportunity not to be greedy, but limiting how many percent against you the stock could go. This one was maintaining 7 stock portfolio, automatically replacing closed positions. When entering this situation, don't close any open positions. So when it moved from a long to a short, whatever long situations were still there, they held. This also gave them the opportunity to hedge and hold both long and short positions at the same time. Don't repurchase the same stock for one day after sale. This then made sure that if they sold the stock, it had to wait for the next day to repurchase it again. And the minimum percentage of stock average volume 10%. Let's go over to the down situation, selling short. All right, so when the DTI combo went down, selling short, filling from the Derby, still looking at today's Derby. So the Derby gives you the opportunity to find what's moving right now using today's Derby for either your up or your down situation, still tracking from the market open. Price all and average volume all, again, means all the stocks prices had to be at least $1. Average volume had to be 100,000 shares. 10 stock portfolio, looking for at least 6 out of the 10 stocks to make money. This also used a profit locker, a smaller locker though, at 15% target, 5% loss. So on the downside, they were tightening their stops just a tad bit to get out of those short positions a little quicker. Understand that in a bull market, the short runs are going to be short-lived. They took advantage of that with the profit locker being a tad bit smaller than on the long side. Still trying to maintain 7 positions in the portfolio. Again, don't repurchase the same stock for one day after sale, making sure that if you closed out, it would have to wait a day before it bought it back again. When entering this situation, don't close any open positions, again, allowing the portfolio to hedge. And that was how that was set up. And in the neutral, using the DTI, they were taking no action, letting the longs or the shorts manage themselves by way of the stops that were there. I do like this situation, a very fast timing signal, good using the Derby to find your stocks to buy or sell at any given time. The Derby, again, folks, is a very powerful tool, and that analysis mode of today's Derby is showing you what's moving right now today from the open. All right, let's close out of that and go to number 3, 249, which was up 23.59%. We'll close and look at that. This also used the DTI combo. Again, this is based on specific values in the Derby timing indicator at different times within the market's day, starting from 9:30. But as long as it was above the value of 1.20, whether it's a bullish or a bearish signal, it would then populate stocks into your portfolio. Now your neutral, I didn't talk about that just a second ago. The neutral would mean if the DTI did not hit the level of 1.20, then it would be in a neutral situation. Either you would let your stops manage the stocks that you were currently in, or it would wait until it was either up or down to populate more stocks in the portfolio. This used a profit locker of a 30% target, 6% stop on both sides for the buy long and the sell short. Also filling from the Derby. Looking at the analysis mode of today's Derby, looking at the market open, price greater than 2, average volume all means that the average volume was greater than 100,000 shares. Now this was a little different. This was looking at least portfolios that had 7 stocks, and the percentage winners had to be 70% of the 7 stocks that were making money, sorted by return on investment, bringing the biggest winner to the top of the list. Now on the sell short side, still filling from the Derby, looking at today's Derby, market open, 2 in all, just like it was on the long side, still 7 stocks. Now the cool thing about this is, even if I don't have a portfolio that has 10 stocks, I was looking for a minimum of at least 7 stocks. This gave me more opportunity to find stocks to buy. Average winners, 70% of the 7 stocks had to be going up and sorted by ROI. Still 7 positions, Don't buy a stock if it violates. Also, in this one, don't repurchase a stock I currently own. So if it's sold out of a stock and the stock was returned to be bought again, it could buy the stock again, and that's both on the upside and the downside. Maximum per stocks per industry on the downside was 4 and 2 per sector, but we did not have that on the long side. So there was a little bit more manipulating the stocks on the downside than on the long side, keeping in mind that we are still mostly in a bull market right now. They were really managing the stocks on the short side. So that's how the top 3 finished out. They did very well using the DTI combo. The first place winner did use the primary wave, but they, for the most part, were using the derby to find their stocks, and they did pretty well. Let me close out of that. I'm going to scroll all the way down to the bottom to find the losers in the Jockey Club portfolios. We had number 122 down 43%. Now, I'm only going to look at one of these, but I have some takeaways when it comes to what happened with the people who did not make money. This was using the primary wave, looking at teeny boppers, supercharged, lower dollar stocks. Close on it. This was the strategy that was found, price greater than $1, but less than $5. Thus the name teeny boppers. Average volume, 25,000 shares. Looking for stocks that were low in market cap, only 25,000 shares traded. Now, the price new high over the last 26 weeks. This is where you put the momentum into these stocks. Scroll down, profit locker, 5% target with a 0.5% stop. Folks, that is a super tight stop and probably generated a ton of trades, thus blowing up the commissions in this portfolio, which probably weighed very heavily in the decision of why this strategy went down as much as it did. 5 positions. When entering this situation, close any open position. This is something else that I got as a takeaway for the losers. Now, they were flipping automatically, increasing the amount of commissions by closing all positions when moving into the next situation. This is the same thing that happened on the downside. When entering this situation, close any open position. So what that was telling me was, as you move from an up to a down, you are automatically closing the existing positions to open up new positions, increasing the amount of money used for commissions the same. Now, if you sold a stock, you had to wait another day before you bought it. Let's go back to the downside. Sell short a bullish strategy. That is another takeaway. Why would you want to sell short a bullish strategy? This was stocks greater than $2, average volume greater than 25,000, recommendation not equal to a sell. So stocks that were either a buy or a hold. Now, this was a momentum search as well. Higher trending stocks over the last 3 weeks and a price new high over the last 13 weeks. Strictly a momentum trade, thus the name up, up, and away. But they were selling it short, so you were probably committing a lot of commissions at this time as well, as these stocks were being shorted but going up. Well, you know, that might be not a good thing to do. I do know that when the market moves down, the majority of the stocks in the market move along with it, but you're shorting a bullish surge. Probably not something that you want to do, and a very tight stop as well. All right, so that was the bigger loser on that side of the portfolio. And again, I'm going to give you some takeaways that I got from looking at the losers. All right, so that was the Team Jockey Club. I'm going to move over and let's go look at Team Midnight Cowboy. And before you all get started, yes, I know that the contest winner of 397 did extremely well in the first 2 days. It was up over 80% at the beginning of the competition, but it finished at about 48.57%, a little bit less than 50% nonetheless. Before we get into the portfolio, let's look at its equity curve. This portfolio took off at the beginning. It really did, and then took off a little bit more, and then towards the end finally fell a little bit. But this portfolio overall was up almost 50%, and a lot of people were saying, well, wait a minute. It found a stock and it really took off. Yes, it did. It found a stock known as DCIX, or Diana Shipping. Let me show you why it found that stock. Let's go look at its competition setup, looking at the primary wave. Remember, this is Team Midnight Cowboy now. Looking at the primary wave, this was the secret sauce. Blyer's bottom feeders. Bottom fishing searches are ideal coming off of market bottoms, but they give you a lot of explosive potential. You look at Blyer's bottom feeders, markets not equal to the closed-end mutual funds, exchange equals to all of the exchanges, average volume greater than 100,000 shares, market cap greater than at least 1 million shares, price actual greater than 2, not looking at ETFs and not looking at the contras, and it had to have some volume. Very interesting in that it had to have some volume. Now, if you scroll down, the profit locker, 25% target, 5% loss, good target for the profit locker. I always think that 5% stop is a little too tight though, but in this case it worked out really well. 6 positions is what it was looking for. When entering this situation, don't close any open positions. So when it moved from a long to a short, it was still maintaining the positions that were in here. Long, average value, don't repurchase the stock I currently own. Again, looking at that, it could get out of a stock today and get back into the stock again. Maximum stocks per industry and sector were 4, helping to keep the portfolio nicely diversified. Let's go to the sell short side. Looks like it had a strategy of its own, short RT times CI ascending. Now, this was looking for ETF short, but it was a bottom fishing scenario for ETF short because the short was RT times CI, or relative timing, times comfort index ascending, putting the ETFs, the contra ETFs, at the top of the list that were the worst. And as the market was falling, these ETFs or contra ETFs would start taking off. So bottom fishing on the long side and bottom fishing for contra ETFs on the downside, bottom fishing all the way around. Profit locker, 20% target, 4% stop, still trying to maintain only 6 positions. When entering this situation, don't close any open positions. Allows you to go back from the short side to the long side, maintaining the short positions or contra ETFs that were already in here. Once that happens, the stops would manage those positions, making sure that they were diversified, 4 stocks per industries or per sector, and that was the setup. Now, the cool thing about this is that was a pretty darn good strategy, even though it pulled back a lot since the beginning of its reign. So, not a bad setup. Again, I like the idea of bottom fishing on both for the bullish side and the bearish side. Number 2 was contestant number 188, up 30.99%. Let's look at its setup using also the primary wave. And I found out that the Midnight Cowboys, for the most part, use the shorter moves in the market primary wave. But we're going to get to that in a second as well. Buy long, looking at teeny bopper supercharged, just like that loser one that we had did, but they did this a little differently. Stop, 15% gain or 7% loss. Pretty much 2-to-1 gain to loss in as far as the ratio. 5 positions, replace closed positions. This one flipped. When entering this situation, going into the long position, close any open position. When entering this situation, close any open position. So this portfolio flipped directly, selling all of the stocks from the previous situation going into the next situation. Now, teeny boppers, price actual greater than $1 but less than $5. Lower dollar stocks, average volume 25,000, and price hitting a new high over the last 26 weeks. So we took a look at that. I do like the stop gain. I actually would think that a profit locker would have done a tad bit better. On the short side, selling short using a really good shorting strategy, Doug's Downer Supercharge. All right, average volume greater than 100,000 shares. Bad earnings per share. Actual price greater than 5. Recommendation equal to sell. Looking for really bad stocks, not looking for ETF shorts. I do like, again, the stop criteria of 15% gain, 7% loss, but I still think that the profit locker would have gotten them just a little bit better. But again, flipping from the long to short, you were creating a lot of commissions by buying and selling stocks back and forth between the longs and the shorts, instead of allowing those stocks that you already had, letting them continue to make money. All right, but overall did very well to finish number 2 in the competition on the Midnight Cowboy side. Number 297, almost 30%. Look at the setup. This one stayed long all the time and used to confirm calls. What I do like about this is the strategy, VST ascending, looking for the stocks in the database that had the worst VST at the top of the list. But the CI, Comfort Index, trending higher for 3 days, RT trending higher for 4 days. This was looking at stocks with the worst VST, but had some momentum going into the search. Price less than $10, VST greater than 0.90. I also like this here. VST divided by RT. Remember, we're looking at VST ascending, but they were also looking at stocks that had good VST but low RT. Again, another sense of bottom fishing, but they honed in on a specific level. VST divided by RT less than 0.8 and VST divided by RT greater than 0.7. So they were looking for VST divided by RT between 0.7 and 0.8. Once the stocks were found, if the market was rising, man, this was a great way to take advantage of some stocks using a longer term call, the confirmed call. Average volume greater than 25,000 shares. Stop was a 30% gain, 12% loss, a little bit more than 2 to 1 for your gain to loss ratio. 5 stocks. When entering this situation, don't close any open position. This again allows me to hedge my portfolio. This was very interesting. Don't repurchase the same stock for 500 days after the sale. What I like about this is no matter what, it was making sure there was new stocks that were taking advantage of this situation at any given time. 500 days is a long time in between buying and selling that stock over again. So for the time period of the 2 months, it was only looking at new stocks taking advantage of the search. I like that, and making sure you kept new blood in the portfolio. Let's move over. On the downside, confirmed down, they did nothing but let these stocks manage themselves by way of the stops. Why? We are still in a bull market, and they were taking advantage of being in the bull market and doing the confirmed down calls, still bottom fishing pretty much in the stocks that were taking advantage of the market's conditions. So in a confirmed down call, any stock that got stopped out, but did not replace with a new stock until you got the confirmed up call. Very smart on this part as well. So a little different, using a longer timing period for the call, but using a very distinct strategy as well. I like that strategy setup, finding stocks with the low VST at the top of the list, but looking for some momentum coming into this situation. I do like that, and honing in on that level of VST divided by RT between 0.7 and 0.8. Not sure how they honed in on exactly that, but they did, and it looked to be a pretty good situation. All right, so those were the top 3 winners on Team Midnight Cowboy. Now, let me show you some takeaways that I got from the contest. Looking at the winners, they used good market timing, whether you were Team Midnight Cowboy or Team Jockey Club. Good searches. Those creative searches that came into place really worked out well, but good searches nonetheless. A lot of them were looking at momentum. Good stops. Maintaining good stops allows you to take profits when you can and mitigate losses. As a trading system, the biggest thing is to mitigate losses so that they don't become big losers. You minimize the trading by doing that with less commissions. Less commissions allows you to make more money in your portfolio, and not allows your portfolio to get eaten up by the commissions, thus adding to losses in your portfolios. Now on the losing side, my takeaways were really tight stops. If you do that, you're going to get in and out of stocks tremendously, and you're not allowing them to really run and do anything for you. All right. And while you have those really tight stops, you're going to commit into more commissions. Quick turnarounds. those portfolios that did the worst really were closing out between situations. On the long side, going into the short side, closing all the positions, and from the short side going back into the long side, closing out of all the positions. Those quick turnarounds created more commissions. Shorting long searches, man, that is not a good thing. And a couple of the losers did just that. We saw that the up, and away, you shorted that. I'm not sure you ever want to short a long search, even in a confirmed down or a down situation. And buying long in one of the downturns, that happened in one of the losers as well. So make sure you allow the trend to be your friend. Stick with the trend and stick with the strategy that's going to be apropos to the trend. If you're shorting in a down market, that's good. If you're buying long in a down market, that may not be so good. All right, so make sure that you stick with the trend and use the right types of searches for the trend. With that, folks, I want to say thank you for joining me for this week's presentation. If you have any questions, by all means, give our product support staff a call, and hopefully you got the gist of what this competition was all about. Coming up with good ways to use the VectorVest software so that you can put a good trading system, whether you're a trader or a longer-term investor, in your hands. And this contest provided you with some great ideas in order to do so. So once again, thank you for being here and have a wonderful evening.